Welcome to vTalkInsight Allocator's Lens Daily for January 22nd, 2026. Cross-asset positioning today sits at the intersection of extraordinary U.S. growth, an AI-driven capex boom, and a more fractured geopolitical and trade regime. That combination is reshaping the balance between equities, bonds, currencies, and real assets in institutional portfolios. In equities, the core tension is between exceptionally strong fundamentals in the United States and a backdrop of rising geopolitical and policy risk. Recent U.S. data show core inflation running at roughly 1.6% over the past 3 months, while fourth quarter growth is projected around 5.4%, a rare mix of rapid expansion and disinflation that underpins risk appetite. The U.S. stock market has already delivered an extraordinary run, with dozens of new all-time highs over the past year and trillions of dollars added to retirement and savings balances, and earnings expectations remain robust, with many large companies projected to grow profits well into the double digits in the year ahead. A key driver behind that strength is the AI and data center investment wave, which has contributed a very large share of recent U.S. GDP growth and is attracting record new capital commitments, far exceeding prior cycles. Enterprise and consumer adoption metrics are impressive. Millions of businesses are using leading AI platforms. Healthcare professionals are integrating tools like chat-based assistants into daily workflows, and advertisers report meaningfully higher returns from AI-driven targeting on major social networks. Yet, even within technology, performance is uneven. Semiconductor names and AI infrastructure beneficiaries are still favored, while software has lagged, creating pronounced divergence and encouraging some investors to rotate toward under-owned areas such as small and mid-cap value, energy, and healthcare, as well as underrepresented regions like Japan and parts of Southeast Asia that combine earnings inflection with currency tailwinds. This constructive earnings picture sits alongside mounting concerns about valuation and concentration. Index-level multiples are historically rich. Leadership remains heavily skewed toward a narrow group of mega-cap technology and communication services names, and investors are increasingly questioning the long-term return on the vast, capital-intensive AI build-out, especially given the timing gap between enthusiasm and realized productivity gains. Geopolitics adds another layer of fragility. Trade tensions between the United States and Europe are escalating, with tariff threats linked even to security disputes around places like Greenland, while the broader post-war global order looks less stable, and some see the potential for further volatility or even a meaningful correction before policymakers feel pressured to seek de-escalation. At the same time, higher defense spending commitments across NATO and a friendlier M&A and regulatory environment in the United States are supporting sectors such as defense, industrials, and deal-sensitive names, contributing to a sense that idiosyncratic winners may continue to emerge even if the broader indices pause. Positioning coming into the latest geopolitical flare-up was the most bullish in about a year, which helps explain why a recent sharp equity sell-off coincided with record highs in gold and silver. Markets have since bounced, and breadth has intermittently looked healthier, with all sectors and a large majority of stocks advancing on some days. But commentators warn that low probability, high-impact risks around trade, security, and policy are not fully embedded in prices. Meanwhile, global M&A has surged, with deal activity up strongly year-on-year and expectations for record U.S. transaction volumes as financing conditions and regulatory predictability improve, although there is concern that surging deal momentum could inflate valuations and erode future returns. From an allocator perspective, the equity outlook now hinges on whether AI-driven productivity and strong nominal growth can offset gradually higher discount rates and geopolitical shocks. How that balance evolves will also shape the relative appeal of other asset classes, starting with rates. Rates markets are increasingly being framed around a slow but persistent return of term premia and structurally higher yields. Several structural forces are at work. Large and persistent fiscal deficits, the ongoing retreat from quantitative easing, and a gradual end to the global monetary easing cycle that is expected by around 2026 in many regions. These dynamics point toward yield curves that eventually steepen from unusually flat levels and bond yields that trend higher over time, even if the adjustment is gradual, which in turn makes equity valuations more sensitive to any upside surprises in inflation or downside surprises in growth. Japan has become a focal point for global fixed income risk. Long-dated Japanese government bonds recently experienced an extreme move, pushing yields to their highest levels in years before rebounding after official comments aimed at calming markets, and authorities are openly considering stabilization measures. Those moves have already spilled over into other markets and intersect with an important flow story. Large foreign asset owners and institutions are quietly reducing exposure to U.S. Treasuries and reallocating toward Japanese, European, and selected emerging market bonds, as relative value shifts and concerns grow over U.S. indebtedness, currency weakness, and policy uncertainty. At the long end of the U.S. curve, the withdrawal of price-insensitive foreign buyers has contributed to persistent volatility, reinforcing the idea that government bonds can no longer be relied upon as the simple hedge they once were. Domestic policy is adding nuance to the rates picture. The administration has instructed government-backed institutions to buy up to $200 billion of mortgage bonds in an effort to lower mortgage rates and support housing, while also floating ideas like temporarily capping credit card rates to ease consumer debt burdens. At the same time, legal challenges around the attempted removal of the Federal Reserve Governor and broader criticism of the central bank's leadership highlight rising concerns about Fed independence and the risk that monetary policy becomes more politicized. For allocators, this combination of strong U.S. growth, modest inflation, gradually rising structural yields, and more uncertain policy anchors means rate risk management and global diversification across fixed income markets are becoming more central to portfolio construction, and they directly influence how credit exposures are sized. In credit, traditional corporate spreads remain tight, reflecting confidence in a soft landing narrative where strong growth, moderating inflation, and healthy corporate balance sheets keep default risk contained. That resilience, however, is increasingly conditional. Commentators stress that a move toward meaningfully higher yields or a growth shock driven by trade frictions and deglobalization could challenge the current spread levels and expose highly levered issuers, especially those tied to cross-border supply chains and tariff-sensitive sectors. Consumer credit sits at the intersection of credit fundamentals and policy risk. Proposals to cap credit card interest rates for a year and ongoing scrutiny of interchange fees have raised questions about the future profitability and business models of card issuers, even if legislative hurdles mean immediate implementation is far from certain. Banks rallied when it became clear that congressional approval would likely be needed, but if any cap were enacted, it could lead lenders to tighten standards, restrict access to unsecured credit for weaker households, and shift risk to other pockets of the financial system. Outside public markets, private credit and private equity are central to the credit story. Private credit has attracted strong institutional commitments, with fundraising and deal volumes rising sharply as large platforms consolidate market share and focus on middle-market borrowers in areas such as data centers, healthcare, and business services that benefit from technological transformation and reindustrialization. Private equity managers, by contrast, face pressure from higher rates and a backlog of deals from 2018 to 2020, representing trillions of dollars in equity that needs an exit, which is likely to drive more secondary transactions and potentially some forced selling. At the same time, global M&A is rebounding and regulatory conditions in the U.S. have become more predictable, supporting sponsor activity, but also raising concerns that deal competition could push valuations too far, blurring the traditional credit equity boundary and feeding into broader discussions on leverage and risk. Foreign exchange markets reflect both cyclical shifts and structural change. The U.S. dollar has retreated sharply in recent weeks and only partially recovered, leaving it vulnerable ahead of high-profile political events that could influence fiscal and trade expectations. Behind the day-to-day moves, global reserve managers and large asset owners are gradually diversifying away from dollar dominance. With a smaller share of trade and reserves now denominated in dollars, and a quieter trend of reducing new purchases of U.S. bonds in favor of other sovereign markets. Clients with historically high dollar exposure are cautious and in wait-and-see mode. But despite the rhetoric, realized reallocations out of U.S. assets remain modest, anchored by the country's strong economic performance and innovation leadership. Regional and haven dynamics add further texture. Earlier this week, the search for safety was channeled more through currencies like the Swiss franc and through gold than through U.S. Treasuries, while the yen remained under pressure even as Japanese yields surged and intervention risk rose. In contrast, Asian equity markets in Japan and Southeast Asia are benefiting from a mix of improving earnings, supportive currency trends, and relatively attractive valuations, which together offer an alternative outlet for global capital looking beyond the United States and Europe. There's also a notable twist in the digital realm. Efforts to harmonize regulation between banks and crypto issuers, including new stablecoin frameworks, are advancing under a regime that in practice reinforces the dollar's role, since most compliant stablecoins are backed by short-term U.S. assets. The New York Stock Exchange's plan for around-the-clock tokenized securities trading, using regulated dollar-based stablecoins for settlement, could further entrench the dollar at the core of digital market infrastructure even as traditional reserves and trade flows diversify. For allocators, currency risk management now spans both conventional FX exposures and the evolving architecture of tokenized and blockchain-based markets, while commodities have become another key expression of geopolitical and inflation hedging. Commodities continue to play a central role in portfolio risk management, starting with precious metals. Gold and silver have pushed to new all-time highs even as the dollar has remained relatively firm, underscoring intense safe haven demand amid geopolitical strains, trade disputes, and concerns about the durability of the post-war global order. A recent pattern of a sharp drop in the S&P 500 alongside record levels in gold and silver reflects heightened risk aversion. Although history suggests that during episodes of extreme stress, even precious metals can see brief, sharp sell-offs before renewed policy responses and inflows reassert their role as hedges. Base metals, particularly copper, are telling a complementary story about real economy demand and structural constraints. Copper prices have reached record highs, supported by persistent supply bottlenecks and rising use in renewables, grid upgrades, and data center construction, all of which are tied to the energy transition and the AI infrastructure build-out. Major potential sources of new supply, including large U.S. projects, face regulatory and legal delays despite political support, and miners are increasingly focused on expanding copper exposure, suggesting that tightness could persist and feed into both capital expenditure plans and inflation dynamics. Energy infrastructure rounds out the commodity picture. Order books for gas turbines have nearly doubled over the past year, with one leading manufacturer seeing its backlog rise to around 80 gigawatts, and hyperscale data center operators are expected to account for roughly a quarter of power equipment demand by 2026. At the same time, momentum is building behind small modular nuclear reactors, particularly in Europe, as policymakers and companies seek reliable, low-carbon baseload power. These trends reinforce a broader theme that assets linked to nominal GDP and real activity from infrastructure and high-quality real estate to metals and energy are becoming more prominent in allocation discussions as investors grapple with tariffs, large fiscal deficits, and the risk that inflation proves stickier than recent disinflation data imply. Across assets, the picture is one of powerful growth and AI-driven momentum colliding with a world of higher structural yields, more fragmented geopolitics, and renewed interest in real assets. Equities, led by the United States and parts of Asia, still lean on strong earnings and investment, but valuations and concentration leave them sensitive to setbacks in productivity or trade relations. Rates are transitioning toward higher-term premia and more volatile long ends as foreign demand for Treasuries becomes less automatic, while credit remains broadly firm but increasingly exposed to policy experiments and late-cycle leverage in private markets. In currencies, the dollar faces gradual diversification pressures even as it anchors the emerging digital market infrastructure, and commodities from gold and silver to copper and power equipment sit at the intersection of safety demand, AI infrastructure, and the energy transition. For allocators, key watch points now include any policy off-ramp in trade and security disputes, the evolution of Japanese and U.S. bond markets, concrete evidence on AI productivity gains, and how political dynamics shape central bank credibility. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.